Good day, everybody. It's good to see you. Welcome to almost the fourth quarter. As we tape, it's September 29th, and yesterday we had our first green day in quite a while in markets. It's been an ugly third quarter. But before I get into that, I do want to do introductions. All of you, I think, by now know our portfolio manager, Bob Key. Bob's up in Boston. Good morning, Bob.
Morning.
And many of you haven't met Jessica yet. Jessica Kinnunen joined our team earlier this year. She's got over 12 years of experience in the industry and has assisted me with client service and is on our investment committee. Good morning, Jessica.
Good morning.
Our goal today in the call is to talk to you a little bit more about what's going on and what bothers us, and more importantly, the things that aren't bothering us. But one thing I want to talk about briefly before Bob shares his thoughts is that if Bob were still at Putnam running his mutual funds like he did, for 30 years, he actually would be getting super high scores and big bonuses. And that's because versus any benchmark out there, our current portfolios are blowing things away. We're having a great year, except for the fact that you all see minuses on your statements. And what I mean by that is because of the way we've constructed your portfolios, your losses are significantly less than their common benchmarks. Now, that all being said, I know most of you don't care about that you want to see profits, and so do we. We get paid on your accounts going up. But on a relative performance basis, we're actually having a pretty good year despite the headlines. But I know that isn't equating to a very fun third quarter statement. So I'm going to stop there, and we're going to turn it over to Bob because Bob wants to share his thoughts. And then we have a couple questions for him. Go ahead, Bob.
Thank you, Bruce. Yeah, and to the your point about the year, it's we are fundamental quantitative investors that use longer term economic data in order to provide value to our clients. A lot of these short term moves tend to be they're by definition not forecastable. They tend to be more technically oriented. And the idea is to make sure we have these portfolios structured longer term. And we know the beta eventually, that's the long term averages of these are going to come through. And we adjust the portfolios in the short term in order to add value above and beyond what those longer term average returns are. So yeah, the marketplace we have right now is probably in my 30 plus years of doing this, the most I've ever seen technicals dominate trading. We've sent out commentaries before about why this may be. It's hard to tell exactly because trading doesn't go on through centralized exchanges anymore. They tend to go on, through people trade electronically right now. So it's not entirely clear that may be part of the cause of it. I would say a bigger cause of it right now is that never before have we had we've had a Fed that's this active before. We've never had a Fed that's talked this much before. So last week or early the week before, actually, when we came through the Fed had their meeting, they raised by another 75 basis points. There was this glorious 5-day period leading up to it where there was a blackout period by the Fed. No one's allowed to speak. Now the Fed governor's allowed to speak to the press, etc. The markets were remarkably stable during that period. Once the meeting has ended and Chairman Powell has given his press conference, then market stumbled again as he spoke about the need to be more restrictive with policy, etc. So a lot of this, what we're trying to handle here, we're confident in our longer term outlooks. The economic variables continue to be very reasonable. The challenge is we don't know what's coming out of not just Chairman Powell's mouth, but all the Fed governors who talk on a somewhat regular basis now and give speeches, et cetera. So that's, I think we're going to continue to get this very volatile market through September and probably October. Eventually, I think once the midterms pass and things calm down a little bit, we're going to get back more to the fundamentals. And we continue to see a slowing economy, sort of a sideways trending economy where we get almost we don't get a full-blown recession. We get more of a rotating recession. We're going to go through different sectors. Different sectors are going to take the hit. Housing's taking it right now through the higher interest rates. But as we know, everything from employment numbers to earnings from corporate earnings, they're very they remain strong at this point in time.
Did you have some slides that you wanted just to put up?
Yeah, that'd be a few observations on some of the economic data.
All right. Can everybody see the screen here?
Nope.
Nope.
Oh, there it is. We have it. Okay. Nice job, Jessica. Excellent job. So the consumer price index, we get the CPI. This is the most widely viewed measure of inflation. The Fed actually looks at something called the PCED, but regardless, this is very comparable, and this is what makes the headlines. This number comes out in the second week of the month following, so we'll get September's reading during second week of October. What shocked the markets was August's number. The headline number was higher than expected. The core number was higher than expected. It's we're very confident, given the drop in commodity prices that we've seen, that we are going to get a significantly lower reading in September. It is very clear to us that inflation is rolling over. Doesn't mean it's going away anytime soon, but by the end of this year, we should be back down in that 5% range, and then probably moving back down to the 3 to 4% range for 2023. Next slide, please, Jessica. So here's the Fed funds rate. What you'll find interesting here is if you look at, typically the Fed has done a graduated increase in the rate. And those almost like, if you look at 2015 to 2016 to 17, et cetera, it almost looks like you're going up a set of stairs, right? They would do 25 basis points at a time. The economy was healthy. We slowly raised the rates. And by slowly raising the rates, not just the financial markets, but the economy in general is able to sort of slowly absorb the rates, and we have a nice steadiness to things, and that's how things go. What is different this time is that if we go and we look at the start of the pandemic, I believe the Fed panicked, quite simply, and just dropped rates instantly to zero, effectively zero. We kept them at zero for a long, long time. In 2021, it was extremely clear we were recovering. The Fed insisted that inflation was not an issue. They did not gradually start to tighten. We kept rates at zero for way too long. Enter 2022, and 2021 was a great year for markets. January 3rd, 2022, that's when markets topped. That's when Fed Chair Powell came out and said we have to aggressively raise rates. Inflation is no longer transient; it's persistent, and now it's no longer persistent. It's something that's becoming an issue, and we have just panicked now in the other direction. So there was overreaction at the start of the pandemic. There was a lack of action throughout, and now we've had an overreaction. So we continue to expect maybe 75 or 100 basis points more, and then we do expect the Fed to take a pause after that. Next slide, please. So let's take a look at just exactly what's happened with yields in that. The rates of yield everyone's more familiar with, but so we see how much the 2-year has gone up from basically 0 to 4.3%. The 2-year is a really good proxy of what investors expect the Fed funds rate to be. So that would, nowadays suspect, the Fed funds rate to be about 4.25% would be the final move on that one. The 10-year has also gone up. One of the things we look at, and it's one of the variables in our econometric framework, is the slope of the yield curve. When the slope of the yield curve is positive, that means generally people expect and by slope, we mean the difference between the 2-year and the 10-year. That means that people expect stronger growth in the future than we have now. When it's negative, that's generally a pretty good indicator of recession. We can see that, it went negative in 2000, it went negative in 08, and it's gone negative now. The way the world is working these days, of course, this yield curve has now gotten back to flat again as interest rates are jumping all around. So this is giving us a recessionary reading. We are watching it, and we think it's primarily due to it is primarily due to the Fed sharply raising short-term rates, but we don't, we're not certain it's going to lead to the same recessionary results as we've had in the past. Next slide, please, Jess. Here's, if you say, well, what happened this year in stocks? What happened this year in stocks is that we went from 23 times earnings to about 15.5 times earnings. So stocks traded a multiple to future earnings. Forward consensus future earnings really haven't, they've slowed a little bit, but they haven't gone negative or anything. We're still expecting about 3% year-over-year growth rate in corporate earnings. So corporate earnings are growing. What's happened is that investors have become extremely concerned that the Federal Reserve is going to tighten to the point at which they absolutely crush the economy and send us into a deep recession. The reason why they are concerned about this is because that's what the Federal Reserve governors and Fed Chair Powell continue to talk about. They continue to emphasize their priority is to get inflation under control, and they will take whatever means necessary to do that, including crashing the economy. This is what Paul Volcker did in the late 70s, early 80s to finally get inflation under control. He just said, you know what, I'm going to purposely create a recession and we're going to get inflation under control. The Fed continues to emphasize that although it would be painful, and they use the word painful several times in our latest Fed minutes, that it is the lesser of two evils, and we must get inflation under control, even if it means crashing the economy into a recession. Next slide, please.
Looks like that's the end.
That is the end. So, we continue to look at the marketplace. We continue to look at where markets are trading, et cetera. We believe investors have overreacted right now on the stock side. We do see inflation peaking. We see a gradual return to normalcy. I think we think it's very likely at the Fed meeting in early November, that will be the last rate hike for a little bit, that they are doing their best to dampen investor enthusiasm, which they have certainly done, and market enthusiasm. But right now, the economic, the economic variables we look at, the ones that are in our framework, continue to be support an economy that is slowing, but not in a recession. We're still probably going to get about 1% positive GDP growth for this year, about 3% year-over-year growth in earnings. And, they should be able to pause at this point. Inflation is certainly rolling over at this point, and we expect 2023 to be a slow grind back to where we were. And late 2023, we see markets starting to approach the previous highs.
So Bob, one of the things I wanted to ask you about, it seems like we have this repeating mantra from the Fed, and it's almost like a competition of who can yell the loudest to, hey, we're almost done tightening, to, oh, we're not even near being done tightening. But you have this going back and forth, and it started right after Chairman Powell got done last week. And earnings expectations get lowered, and then the S&P 500 companies start to report, and guess what? They beat the numbers and the market rallies.
Right.
Saw that in July, into the middle of August, we had gotten back almost half of the losses for our clients, and then the Fed started talking again. Nothing changed in economic data. It looks like we're set up to have that happen again in the beginning of the fourth quarter, doesn't it?
Yes, and your point's a good one. It's not the as a history lesson, right? The Fed used to not speak at all. And we'd encourage them to consider going back to that model. But the Fed would release their minutes, you'd read their minutes, you'd interpret their minutes, and then you'd wait for the next Fed meeting to hear what they have to say. The issue is less about how frequently they're speaking, although it's way too much. It's that they keep pivoting back and forth. You're right. We hit lows on June 16th. That Chair Powell came out and became much more dovish towards inflation, says he thinks the worst is over. He said he sees rates at neutral right now. And that's where we got a 16% rally in stocks, because he said rates were near neutral. In August, he came out and said, oh, no, we're not even at restrictive yet. The market's plummeted back down again. We are very reliant on what they ultimately do. In the short term, markets are trading on what they say. I don't personally see inflation as systemic at this point in time. It is absolutely high. They've created inflation. It's going to take us a long time to get back down to that 2% level they talk about, but it is dropping, and should drop consistently, and you shouldn't need to completely crash the economy. This is not the 70s for a whole bunch of reasons. One being that we don't have the commodity shortages or wage price spirals that we had in the 70s. So we think their tough talk is on purpose, that they are trying to slow people down a little bit. Consumers still have way too much money from all the free money that was given out during the pandemic. You see consumer savings is extremely high still. So I think they are trying to spook investors, spook the consumer a little bit to slowing themselves down and getting inflation under control.
On that note, Bob, if this situation is so bad, why is unemployment so low?
Yeah, and that supports what we're just talking about. It's hard to have a recession when you have 3% unemployment, right? Something has to be wrong here. Again, this is not, we do not have high unemployment. High unemployment is certainly synonymous with a recession. They're spooked about the inflation that, I think they're largely responsible for. Fiscal policy is too. They're trying to get that under control. And their way of doing it is to, not just act as they're acting in tightening monetary policy, both by raising rates and quantitative tightening, but also through talking. The dual mandate, Jessica, is price stability and full employment, right? Well, we have full employment, so I guess they're successful in that. Their job is not to create unemployment. Their job is to get prices stable again.
Switching gears a little bit, what are you thinking about international stocks?
It's going to be a long time, I think, before we return to that world. For a U.S. investor, there's two things that drive their international stock returns. One is how their stocks perform. The economy's over there, but the other is the currency. So quickly on the currency, all major currencies are at pretty much all-time lows against the dollar. The dollar strengthened considerably. The reason why the dollars have strengthened considerably is that not only is the U.S. being restrictive in their monetary policy and getting inflation under control, etc., the U.S. is just a far more attractive marketplace for people to be in. As everybody knows, there is a war going on in Europe right now. They are having a 70s style energy crisis that we are not having right now. Truth is stranger than fiction. They're entirely reliant on Russia in order to supply them with natural gas to keep their houses warm this winter, to keep their businesses running, etc. Needless to say, that relationship is complicated at best. Russia's cut back. There's been destruction of the Nord Stream 2 pipeline. They're simply not going to have enough energy. Energy prices have tripled over there. It's just not an area. It's just not necessary to invest internationally at this point in time.
Okay. So given the correction, do you think that long-term investors should increase their risk right now?
That one comes back. The answer is from a pure, sitting in a box where I don't have to deal with human interaction. I would be comfortable saying yes. That's why I'm glad I had you and Bruce to speak with your investors personally. As we know, people's tolerance for risk is not as simple as filling out a spreadsheet. You need to have a relationship with your advisor in order to do that. That relationship with the advisor, again, it's not just what they say. You have to, fully understand what their capacity for it is. If somebody is truly comfortable tolerating whatever volatility markets may hold for the next 6 months, year, maybe even more, I like the idea of increasing risk. The number one thing we need to do for all investors right now, though, is keep them invested. Keeping people invested is what ultimately is going to be the most important part here. So I'm going to put that back on you. Yes, from a pure investment standpoint, I like the idea of increasing risk. You and Bruce will have to determine on an individual basis who can and cannot tolerate the short-term volatility until that increased risk pays off.
Makes sense.
Thank you, Bob, and thank you, Jessica. I was just going to add that as we do our rebalancing and as we change up the models, Bob and I and Jess have this talk every Friday, and we are resistant to add risk in the portfolios right now, even though we think it could be a good idea. However, if you are a long-term investor and the volatility doesn't bother you, or for those of you who've worked with me a long time, if you want to buy tuna fish on sale, you let us know that and we will move up your risk tolerance like we've done at other times when we've had these corrections. I want to thank Bob for taking time out for this call today from Boston. Jessica and I are here in Marquette, but our thoughts and prayers go out to everybody in Florida who's been impacted by Hurricane Ian. And obviously I have more than a few friends in South Carolina, and Bob's even got family in South Carolina right now, so we're watching that closely. We wish you all the best. We thank you for your business. And by all means, remember, we're here for you. Reach out to us if you need us. Thank you and have a great day.
Thank you.